Central bank news heading today. The Bank of Canada will begin tapering its bond purchases. We're waiting also on language for the ECB. Let's talk bonds. Our first chart with Mr. Mark Newton joining us, president and founder at Newton Advisors. Mark, looking at TLT, let's start there. I understand that you're looking for some more weakness to show up in this trade.
Yeah, it's tough to say the bottom is truly in, Oliver. I mean, we've seen TLT get to nearly the most oversold we've seen in over 20 years, but, still a very strong trend to the upside in yields in the near term. So, it might be possible we see a bit further weakness before that truly bottoms out.
Okay, so right now we've gotten this little bid here the last couple weeks. Everybody's thrown in their 2 cents on why it's happened fundamentally, but from a technician standpoint, what do you see as the explanation?
Well, I just think that near term things got a bit too far, too low. We did get pretty oversold. Sentiment obviously started to get very negative with regards to TLT. So it is right to see a little bit of a bounce here. But when you look at things like TNX, for example, 10-year yields, I think it's probably capped at levels right near 1.5%, and we probably have a little bit further to go on the upside right near 2%. And so we'll see whether that in fact spooks technology or some of the other parts of the market.
I'm reading your note in which you point out there are Ichimoku cloud resistances. I don't know what the heck that means, Mark. It sounds pretty cool, but the bottom line is it looks like 141 seems like it might be a limit to the upside.
Yeah, we want to study some history and look at what the Japanese rice farmers used, 400 or 500 years ago. And so that's obviously very important. It still tends to be very key in how some people look at the markets. But, look, it's a challenging market. It's interesting. When you look at the broader market, the reopening trade certainly has gotten a bit too much over its skis. When you look at the stay-at-home trade, that hasn't worked for the last few months. So markets made all-time highs just about 3 days ago, but yet it certainly feels a lot more difficult for those that are trying to trade this tape. There's a lot of things that have not worked since mid-February, and the growth trade certainly has fallen apart. We see real difficulty with small caps, and so the market indices are a little bit of a mirage in terms of what truly has been working. And I think that's important for investors to note, is that the character of this market has really been changing quite dramatically over the last few months.
Very important point. So the prices that you see for TLT, 137, you say looks likely, 136 possible?
Yeah, I do think that, within the next week or so, we should see some evidence of that, potentially trying to turn back lower for one final push. But, if equities are going to roll over, that's probably going to spark some sort of a bid into the so-called, risk-off trade, and we will see treasuries likely sort of rally further in the months ahead. So, I think any sort of yield, backup in yield is going to prove short-lived for now. I am willing to, still hold off on getting too aggressive in buying treasuries, but, I think those should be some opportunity just because things have gotten, well ahead of itself. I mean, treasuries have been really one of the worst performing assets. I think the first quarter, it's been really awful for those that have been long duration. And so, this is certainly should be an opportunity between, the months of May and September as we see some sort of a risk off trade for the equity market. And for now, though, I think it's just sort of a tricky spot with regards to TLT.
Okay. What about for gold? I see that you're not buying in yet to this gold bounce we've gotten. It's starting to get kind of impressive, no?
A little bit with regards to, near-term price action. I would argue that the dollar, still could have one final move to the upside. And if Treasury yields move back higher, you recall that gold really peaked out last August right as yields were bottoming.
That's right.
The real thing is do you think this little move in Treasury yields is going to continue and pull back down to new lows? And if so, then yeah, sure, gold likely works very well as the dollar is dropping. I tend to think the last few weeks have been a little bit of a shakeout with regards to both yields and also the U.S. dollar, and both have the chance, I think, to move up over the next 4 to 6 weeks. So gold still is in a very seasonally weak time, really until the summer. And also, I don't see the degree that people have gotten all that, bearish just yet on gold. When you look at just the CFTC data, when you look at hedgers, when you look at really the long specs, I don't think that we're at levels yet that mark real capitulation in this move to the downside. So, from an Elliott standpoint, I view this as being, a little bit of an ABC type corrective move to the upside, and then we actually should pull back and get down to near 1600, if not 1550. So maybe that's wrong, but if my thinking is right, that the yield still can move a little bit higher, and also the dollar can have a little bit of a bounce here, then it's going to be very, very difficult for the precious metals to continue through.
Okay. Like that connection to the beginnings of that gold downdraft and the tie-in with rates there. So much of this comes down to one's view on bonds. Let's go to the Nasdaq as a natural next stop then, as we also saw that connection in February, March, and over the past month too, as bonds rally, the Qs did as well. So, Mark, what I think is interesting is thinking about that in relation to the bond market. If you're bearish on treasuries, does that require you to be bearish on Qs?
The correlations, I don't know if they always stand up. It is a concern to me to see this sort of intra-market divergence where, the Nasdaq composite has not taken out February highs yet. And yes, the Qs have obviously done quite well. A lot of the FANG stocks have done well, but technology has been a little bit of a laggard since the middle part of February. And I think that's important, that we've seen a big push into these defensive sectors. Utilities has been one of the best performing sectors over the last week, along with, REITs. And so, you are starting to see a defensive push. Technology is certainly not acting well. The leading sectors like, semiconductors and transports were both laggards last week. So it's a little bit of a warning sign for me, even though the markets are still acting quite well. I see about the potential for 2 to 3% on the upside, and markets have been up 6 out of the last 7 months or so, really since last October. S&P is up nearly 27%, almost uninterrupted. So we are nearing a time when we should be prepared to take a breather, and part of that involves sentiment. Part of it does involve this defensive trade. Nasdaq starting to lag a little bit. Technology, 27% of the market. It's always going to be important if tech really starts to roll over. I don't know that we can arguably say that we're there just yet if all these huge FANG stocks, which comprise such a large percentage of the indices and ETFs, are going to act well. But, we seem to be starting to show some real evidence of lagging in the semi space. So we'll see if that can continue.
Okay. Mark, looking at that potential for the Nasdaq to resume, is there a level that you think looks like an obvious next stop for Qs if we do find ourselves continuing to break out?
345 to 350, I think, over the next few weeks. Okay. If markets move up there, I would certainly look to sell into that.
Okay.
I think that we are going to be very close to an area where we start to see some volatility. Arguable that it's here now. We've seen only 2 down days. We're not even down under last week's lows. So the indices themselves are still very strong. It's going to be key for the Qs to really get up above, for the Nasdaq composite to break its February highs, and for the Qs, if the semis can hold here near 3,100, I think the stocks start to push up, then that would be a sign that it should help, the Qs. And also the biotech trade. The biotechs have been awful. I mean, healthcare has been a very, very good sector, but a lot of it's been pharmaceuticals of late. We've seen the hospitals and managed care stocks and biotechs have been real laggards, but those are obviously huge parts of the Qs, along with, the major parts of technology. So, right now it's right to, I guess, be bullish, but, there are some warning signs, and we'll wait and see if we have any sort of move down to new weekly lows that would give rise to, a larger pullback. That might be postponed until, late May into the month of June, which I expect should be seasonally weak.
Okay, so if the semiconductors can find some strength, expect the Qs to as well. We'll test that with Lam Research this afternoon. And then naturally, I would guess then if the charts look positive for the Nasdaq, they look positive for S&P 500, do you, Mark?
Yes, they do. Near term, I still think S&P gets up to 4,200, between 4,200 and 4,300 between now and probably the early part of May. And so I still think it's a little bit early to fade this trade in general, but and look at what's happened with the liquidity. I mean, I think nobody knows what can happen when we have $6 trillion in stimulus in 6 months, another $2 trillion. And, the amount of liquidity right now is just enormous. And so the high yield market is acting quite well. That's typically the first warning sign of when stock market can start to sell off, is when you really see weakness in high yield and credit, and right now credit's in very good shape. So, I think you have to lean on sentiment. If you're a bear, I mean, the things I'm looking at are just the move to defensive trading, obviously entering a seasonally very more difficult time. Cycles start to turn down in the month of May, really into September. And, the sentiment seems quite optimistic. For the first time, you're seeing individual sentiment now match what you're seeing in the institutional side. So Investors Intelligence seeing the highest level of bulls in almost 5 years, very low bears, AAII, DSI levels are very high. Put to call levels have been low for some time. That hasn't really mattered. But you're going to have to watch the sectors. Right now, the sector strength is outstanding, and we've seen other groups come in to bail out technology, financials, energy. Now we're seeing healthcare in recent weeks.
Yep.
That's important. Healthcare is the third, arguably the second largest sector within the S&P, second to technology. So if healthcare can work, then the market's still going to be in good shape.
Hey, Mark, last one real quick. The Fez, you're looking at European investing and a chart that also seems like you expect trend to continue to the upside.
Well, it's been an impressive breakout to really multi-year highs. Europe has been a laggard for some time, and now that seems like it's finally starting to play catch up. And so, daily charts have pushed back higher. We'll see with regards to this lockdown in Europe has any sort of long-lasting effect. But with regards to the Euro stocks, it still is acting very, very well and seems to be trying to play catch up. Still quite a bit of ways from its all-time highs. So relatively weaker on a longer-term perspective, but short-term, this catch-up trade and on a weekly basis, seeing the Fez get up over prior peaks that have been seen on a multi-month, if not yearly basis. Certainly important in my view. Okay.
Mark Newton, always like the walk through the charts. Thanks a lot for your take.
Thanks, Oliver. Take care.
Thank you. Mark Newton is the president and founder at Newton Advisors.